Hey everyone, this is Scott here again with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in today's video, you'll be learning about a variant on the Iron Condor option trading strategy, and that's going to be the Skewed Iron Condor. And so this will be a great strategy to use if you are still mostly directionally neutral on a stock, but you don't also mind leaning a bit bullish or a bit bearish at the same time. And if that sounds interesting to you, then please do me a favor and hit the like button on this video and subscribe to my channel so you don't miss out on any of my future content. Now, very quickly before we get started here, if you would like to take some in-depth classes on options trading, and stock market investing, then check out my courses on SKILLSHARE. I've been teaching on that platform for well over a year at this point, and in case you aren't aware, SKILLSHARE is a lot like YouTube, except the content on that platform is geared solely towards the purpose of education in the form of online classes. And in my courses, you will see a lot of the detailed research and analysis that I've done using real stock market data with spreadsheets, graphs, and even computer programs that I have written to help simulate and prove the concepts that I am teaching. And I provided some links to some of the more introductory courses of mine in the description of this video below. Now, you will need a premium membership with the SKILLSHARE platform if you do want to watch my courses. But if you do sign up for that membership, using the links provided in the description of this video, you'll get an absolutely free 2-week trial. And during that time, you can watch all my courses on SKILLSHARE absolutely for free. And then once your trial is over, it will only cost you a few dollars a month to maintain your membership. And you'll gain access to all the future courses that I plan going forward, in addition to all the other classes that are on SKILLSHARE as well. And if you decide it's not for you, no worries, you can cancel before your trial's over and you won't lose a dime. But again, if you are interested, then check out those links below and join the thousands of other students that have already taken my classes. And so with that being said, we're going to jump on over to my trading platform now and we'll get things started. Okay, welcome to my trading platform here, and the stock we'll be analyzing today is going to be Alibaba. And in case you aren't aware, this is just an online e-commerce company based in China. It's basically just like Amazon, but obviously based in China. And so given that the Skewed Iron Condor is just a variant on the regular Iron Condor, I am going to conduct this video a bit differently compared to my other option trading strategy tutorial videos. Right, so I do have a separate video that takes a deep dive into the regular Iron Condor. And in that video, I go very in depth in explaining all the different situations or scenarios that could play out for the Iron Condor strategy. Basically in terms of where the stock ends up by the expiration date, and how that will affect the profitability of the Iron Condor. And so because the Skewed Iron Condor that you'll be seeing in this video is just a variant of that, there's no need to repeat myself and once again explain all the different kinds of scenarios and situations that could play out by the expiration date, because they'll be exactly the same for the Skewed Iron Condor. So that being said, if you have not seen my regular Iron Condor YouTube video, and if you are not aware of what the Iron Condor is, I do recommend you watch that video first. And so I will post a card above linking to that one so you can watch it. So again, if this is the first time you are hearing of the Iron Condor strategy, watch that video first, then come back to this one. And so the Skewed Iron Condor now basically is exactly how it sounds. It has a skewed directional bias to it, which is very different from the regular Iron Condor because the regular Iron Condor is directionally neutral, right? When you use that strategy, you want the stock to just bounce around in a nice range and not really go anywhere. With the Skewed Iron Condor, however, you still want the stock to be somewhat range-bound, but it can have a slight directional drift to it, either to the upside or to the downside. So based on your moderate directional assumption on the stock you're looking at, you can skew the Iron Condor to reflect that. And so for the case of Alibaba here, I am somewhat bullish on this stock. You can see as of now the stock price has come down to a reasonable support level, but I am also a bit cautious with this stock because as of right now currently, a lot of Chinese stocks are getting hammered in the stock market. And so I do want to put on a bullish trade here, but I don't want all my risk all to one side. So instead of selling a put credit spread or a naked put and having all my risk to the downside, that's why I would consider a bullish Iron Condor for this particular stock. And so I would say right there, that is one of the main use cases for the Skewed Iron Condor. If you are only moderately bullish or moderately bearish, or you just don't want all your risk to one side of the stock, then the Skewed Iron Condor could be a great selection. So let's come on over to the trade tab now and take a look at the option chain here. And let's go into the May expiration cycle. And I'll scroll down just a little bit. So I'm going to set up first a regular Iron Condor, and then I will show you how we can skew it to give it some bullish bias to it. So for a directionally neutral iron condor, I would probably sell this call option right here. This is the 255 strike call option. And then for the put side, I would sell this 200 strike put option. And then for the wings, my protection basically, I would just go out $5 wide on either side and buy those options. So I would buy this 260 strike call option and then also buy the 195 strike put option. And that would complete my directionally neutral iron condor. And the reason why this iron condor would be directionally neutral, the reason why I specifically chose these options here is because of the delta on both of these options. Right, you can see in this column right here, for both the calls and the puts, these are all the deltas for all the options. And in case you are unaware of what delta is, it is simply a metric that comes out of option pricing that will tell you how much the price of an option will move for a $1 move in the price of the underlying stock. And I do also have a separate YouTube video that takes a deep dive into option delta, and I do recommend you watch it as well. So I'll post a card above linking to it. But just as a quick example here, let's say Alibaba moves up by $1, in which case the price of this put option is going to decrease by about $21. Right? That's because when a stock price increases, the price of put options decrease. So that's why the delta for put options is negative. And then for the call option here, since call options increase in price when the underlying stock also increases in price, that's why the delta here is positive. So if Alibaba increases by $1, then the price of this call option is going to increase by about $20. Very simple. And so now the final piece is, given that I have sold both of these options, or I would sell them as part of this iron condor, that means I want, as the seller of these options, I want the prices to decrease so that I can buy them back at a lower price and make the difference as profit. But if the price of this call option increases by 20 bucks and works against me, and the price of this put option decreases in price by right around 20 bucks, which works for me, the overall net combined result is I lose 20 bucks here, make 20 bucks here, net, I don't make or lose any money. The deltas on these two options totally cancel each other out. So that in particular is what makes this iron condor directionally neutral or delta neutral. And the same thing applies to the options we're buying as part of our protection on this iron condor. Right, you can see for the 195 strike put option, the delta is negative 17, and for the 260 strike call option, the delta is 17, so they totally cancel each other out as well. And the last thing I want to show you here before moving on is ThinkOrSwim actually allows you to analyze your trades before you actually make them to see the total delta of the position beforehand. So what I can do is first set up the order. So I'll right click on the 255 strike call option and go to sell, and then go to iron condor, and that brings up the order down here. So we're going to sell one contract, 255 strike call option, then also buy one contract of the 260 strike call option, and then for the puts, we're going to sell one contract, and it's going to have the 200 strike right here, and then finally we're going to buy one contract, and it's going to have the 195 strike, which would be right here. And you can also see for selling this iron condor, you would take in about 160 bucks. So that's a decent amount of credit for a $5 wide iron condor. And now what I can do is right click on this order and go to Analyze Trade. And that brings me to the Analyze tab here in ThinkOrSwim. And you can see the order duplicated down here. And now if you come over to the right and look at the delta column, this number right here, this 0.89, this is the total combined delta for this iron condor. Now the delta you see here is going to be interpreted a bit differently than if you're looking at an option in particular, right? Because for put options, the delta is negative. For call options, the delta is positive. The delta here shows you how much money you'll make for a $1 increase in the price of Alibaba in this case for this position, for this iron condor. So for example, if Alibaba increases by $1, then this iron condor is going to be profitable by around 83 cents. So there is some ever so slight bullish direction to this iron condor, but 0.83 is very close to zero. So this is basically as directionally neutral as you can get. A perfectly directionally neutral iron condor would have a delta of exactly zero, but 0.87 is definitely good enough. And so now let's come back to the trade tab here, and let's take a look at how we can skew this iron condor to be a lot more bullish. And once again, it's all going to come down to the deltas of the options we buy and sell. So now what I can do is, instead of selling the 255 strike call option, I can push my calls further away and sell the 265 strike call option, and then as my protection buy the 270. So the 265 is right here, and then on the put side I can move my puts closer in and sell maybe the 210 strike put option and then buy the 205. And now you can see the deltas for these put options are no longer the same as for the call options here. And that's what makes this iron condor skewed. And so to make this more clear, let me change these strikes down here to reflect our skewed iron condor now. So we're going to sell the 265 strike call option and then also buy the 270 strike call right there. And then for the puts, we're going to sell the 210 strike put option right there and then buy the 205 strike put option right there. And you can also see the credit has increased for this iron condor. Now it's up to 194 bucks, so that's definitely a nice benefit. And once again, I can right click on this order, go to Analyze Trade. Let me expand this tab up a little bit here. So at the bottom, this is the skewed iron condor order. And now if you look at the delta on this iron condor, it's 2.92, almost 3. So again, this means if Alibaba increases by $1, then factoring in the deltas of all these options and how they cancel each other out to some degree, the total delta of this iron condor from my perspective as the seller is that I would make about $2.89 for a $1 increase in the price of Alibaba, which is definitely significantly higher than the neutral iron condor. Now there is also a second way to skew an iron condor. Let's come back to the trade tab here. The second way is to widen the strikes on whichever side you're more comfortable taking on greater risk. So let's say I did not want to sell put option any closer than a 210 strike, but given that I am bullish on the stock to some degree, I am okay having a bit more risk to the downside. So now what I can do is, instead of buying the 205 strike put option, I can buy the 200 strike put option and make the width of my put spread here $10 wide compared to only $5 wide for the call side. And so now, having done this, this is going to give my iron condor here even more bullish delta to it. So once again, I can right click, go to Analyze Trade, and expand this up again. So at the bottom here, this is the even more skewed iron condor, and the delta on this one is 7.26. So now if Alibaba increases by $1, then this iron condor is going to be profitable by over $7. And I do know I'm only showing you this stuff for a bullish iron condor, and that's because I'm trying to keep this video somewhat short, but all of this stuff does apply for a bearish iron condor as well. If I was bearish on Alibaba, I would simply adjust my strikes such that my call strikes were closer to where the stock is trading, and my put strikes were further away. And also on top of that, I could increase the width of my call strikes to give my iron condor more bearish delta. So again, everything I'm doing here with the bullish iron condor can very easily be mirrored with a bearish iron condor as well. And a final thing to note before wrapping this video up is deltas are also dynamic. The deltas you see here on all these options, both the puts and the calls, they will also change as the price of Alibaba moves around as well. And specifically what will happen is, if Alibaba does continue to increase in price, my iron condor down here, my initially bullish iron condor, will slowly lose its bullish bias. The bullish delta you see on the Analyze tab here, the 7.24 for example, will slowly decrease as Alibaba rises in price. And actually, if Alibaba gets too close to my calls, then this delta can actually flip and go negative, which would then make this iron condor actually bearish. So that's why, tying back to the beginning of this video, when you are using a skewed iron condor, you do still want the stock to be somewhat range bound. You don't want it to just skyrocket or plummet to the ground. The ideal scenario is somewhat range bound action, but with some slight directional drift to it. And so that concludes this video. I hope you enjoyed it, and please let me know your thoughts or if you've got questions in the comment section below. And don't forget, if you want to take some in-depth classes on options trading, and stock market investing, then check out my Skillshare courses, links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel, and make sure those notifications are turned on. I'll be dropping new videos every Monday, Wednesday, and Friday, and you don't want to miss out. So thanks again for watching, and I'll see you next time.